Inflation is the silent enemy of investors. Most people focus on nominal returns, celebrating gains on paper without realizing that rising prices are quietly eroding their purchasing power. Your money may grow in dollars, but its real value could be shrinking year after year. Even moderate inflation of 2 to 3% annually can drastically reduce the future value of your investments. Many investors never notice this until it's too late, thinking they're building wealth when they're actually losing ground. Inflation doesn't just affect large purchases. It can silently erode retirement savings, emergency funds, and even small investments. Understanding how inflation impacts your portfolio is crucial to protect your assets and grow real wealth. Today, we'll break down how inflation works, how it affects different types of investments, and strategies to safeguard your portfolio. By the end of this video, you'll know how to fight back against this silent profit killer, preserve purchasing power, and keep your money working for you in every market condition. 1. What inflation really means. Inflation is the rate at which the general level of prices for goods and services rises over time. When inflation increases, each dollar you hold buys less than it did before. This hidden erosion can quietly reduce your wealth even if your account balance appears to be growing. Inflation isn't just about higher grocery bills, it affects every aspect of your financial life, from investments to retirement planning. Many investors underestimate its long-term impact, assuming their returns will always outpace inflation. Understanding the difference between nominal returns and real returns is key. Real returns account for inflation, giving a true picture of your purchasing power. Ignoring inflation can turn a seemingly profitable portfolio into a losing one over time. Monitoring inflation trends and understanding its effects is the first step towards smarter financial decisions. 2. How inflation impacts stocks. Stocks are often considered a hedge against inflation because companies can raise prices and pass costs to consumers. However, not all stocks perform equally well in high inflation periods. Companies with pricing power, strong brands, or essential products tend to maintain profits, while smaller or highly leveraged firms may struggle. Inflation can also increase input costs, reduce margins, and create market volatility. Many investors assume equities are always safe from inflation, but rising interest rates and economic uncertainty can hurt even large-cap stocks. Diversifying across sectors and choosing inflation-resistant companies can help protect your portfolio. Historical data shows that some sectors, like energy or consumer staples, outperform during inflationary periods. Monitoring these trends allows you to position your portfolio strategically. Keeping an eye on company fundamentals helps you avoid stocks that could underperform during rising prices. 3. Inflation and bonds. Why fixed income suffers. Bonds are particularly vulnerable to inflation because they pay fixed interest over time. When inflation rises, the real value of these payments declines, reducing purchasing power. Long-term bonds are even more sensitive since their fixed rates can be outpaced by rising prices over decades. Many investors rely on bonds for stability and income, unaware that inflation can silently erode these benefits. Inflation expectations often push interest rates higher, lowering bond prices in the secondary market. Investors who ignore inflation risk losing money in real terms despite nominal return. Understanding duration, choosing inflation-protected bonds, and laddering maturities can help mitigate this risk. Balancing your fixed income allocation with inflation-resistant strategies is essential for long-term wealth preservation. Staying proactive about interest rate trends can further reduce the risk of inflation-eroding bond return. 4. Cash and savings, the hidden danger. Keeping money in cash or traditional savings accounts seems safe, but inflation makes it risky. Even low-level inflation erodes the purchasing power of cash over time. A $10,000 account earning minimal interest may actually be worth far less in real terms after a decade of rising prices. Many investors underestimate this risk, treating liquidity as a sufficient hedge. Cash is important for emergencies, but over-allocating to it can silently destroy wealth. High inflation environments demand smarter strategies, such as using high-yield accounts, short-term bonds, or inflation-linked assets. Protecting cash against inflation ensures your emergency fund retains its intended value. Awareness of this silent cost prevents a false sense of financial security. Planning how much cash to hold versus investing can help maintain both liquidity and growth. 5. Real assets. Your inflation hedge. Real assets like real estate, commodities, and precious metals often outperform during inflationary periods. Property values and rental income tend to rise with prices, While commodities such as gold act as a store of value, including these assets in your portfolio diversifies risk and preserves purchasing power. Many investors overlook real assets, focusing solely on stocks and bonds, leaving themselves exposed. Diversifying into inflation-sensitive investments can help maintain the real value of your portfolio. It also provides stability during market turbulence caused by rising prices. Allocating strategically to real assets is a key tool for long-term wealth protection. Using a mix of tangible assets and income-generating properties can create a robust defense against inflation. 6. Adjusting your investment strategy. To combat inflation, investors must rethink traditional strategies. Focus on assets that grow faster than inflation, such as dividend-paying stocks, growth equities, or inflation-protected securities. Rebalancing your portfolio periodically ensures you maintain exposure to these assets. Consider global diversification to hedge against domestic inflation trends. Many investors make the mistake of maintaining outdated allocations that fail to address rising costs. Monitoring inflation indicators and adjusting your strategy proactively allows you to preserve real returns. Staying flexible and informed is critical for long-term financial health. Diversification combined with inflation-aware choices ensures your portfolio continues to grow in real terms. 7. The role of taxes and inflation. Inflation also affects how taxes impact your investment. Nominal gains may push you into higher tax brackets, reducing net returns even further. Real gains after accounting for inflation and taxes can be minimal or negative if not managed carefully. Many investors overlook this hidden erosion, assuming taxes alone are the primary cost. Using tax-advantaged accounts, strategically timing sales, and planning withdrawals can mitigate combined inflation and tax impacts. Understanding this dual effect ensures your wealth grows in real term, not just on paper. Careful planning maximizes compounding while minimizing hidden losses. Factoring taxes into inflation planning prevents unpleasant surprises when calculating real net return. 8. Protecting your portfolio long-term. The key to surviving inflation is proactive portfolio management. Diversify across asset classes, sectors, and geographies. Include inflation-protected bonds, real assets, and dividend-paying stocks to maintain real wealth. Monitor economic trends, interest rates, and market signals to adjust allocations. Many investors ignore inflation until it erodes their gains, making early action crucial. Combining growth-oriented and defensive assets creates a balance between protecting purchasing power and generating return. Discipline, awareness, and strategy turn inflation from a silent killer into a manageable factor. Planning today ensures your portfolio grows not just nominally, but in real purchasing power over decades. Reviewing your portfolio regularly keeps your investments aligned with changing economic conditions. If this video helped you understand how inflation silently eats into your investment returns, it's time to act. Review your portfolio, diversify across assets, and include strategies that protect real wealth. Avoid relying solely on nominal returns and plan for long-term purchasing power growth. Share this video with someone concerned about rising prices, subscribe for more investing insights, and hit like to support content that empowers smarter financial decisions. Protecting your wealth against inflation today ensures stability, growth, and financial freedom tomorrow. Start adjusting your investments now before inflation quietly erodes your hard-earned gains. Every step you take today strengthens your real financial future. Take control of your portfolio today and build strategies that withstand inflation over the long term.